John, this is just the latest in a bit of a stream of disappointing numbers we've had out of China. What's weighing on the factory gate?
Well, I think the big issue is demand. There has not been the amount of demand that economists had thought there would be by this point in China after the reopening. The first 4 months of this year, we continued to see industrial profits at industrial companies continuing to drop year on year by 20%. That's actually slightly better than the first quarter when it fell by 21%. And actually in the month of April, we saw it increase slightly under 4% versus in March where we had a decline of more than 19%. But that is way worse than people expected because at this time last year, we were in the middle of a bunch of lockdowns in China. And now we would have expected a big jump in that number as a result year on year, but we have not seen it. And that's what's been disappointing the market.
So there's an expectation that the PMI for China, the latest Purchasing Managers Index from the manufacturing side, might do a little better, might pop a little bit above 50, which separates growth from contraction. What's that going to mean for the PBOC, the People's Bank of China? People are waiting for some kind of step towards more stimulus. They seem to hint at it, open the door, but not walk through.
So I think there's a bunch of issues the PBOC is trying to balance at the same time. So you have the state of the Chinese economy, as you said. PMI has been weak the last couple of months. It might strengthen over the 50 line into expansion for the month of May. We will find out very soon. That will help the PBOC, which is also having to consider the currency with Chinese growth being weaker than expected and the United States getting past the debt ceiling issue, potentially another hike coming in June from the Fed. The PBOC has to think about what loosening will have, the impact it will have on the currency and what that means for financial markets here in China.